Hi, in an earlier session we talked about the overall structure of the balance sheet being, the major components of the balance sheet being assets, liabilities and the equity section. So what we're going to do in this session is have a more detailed look at the assets section of the balance sheet. As we discussed earlier, one of the major things about the asset section, an asset is a thing that you own. An asset is a thing that you control. So we need to make sure that in the balance sheet, at the particular date that we're drawing the balance sheet, that we record the actual figure that should be there and reflect what the actual financial position of the business is at that particular date. So the most common sorts of assets that we'll see in a balance sheet, we'll see cash at bank. Okay, so that will be positive funds you've got in the bank. So it could be if you've got a $10,000 deposit with the bank, that's fine. That will be recorded in the cash at bank section in the balance sheet at that $10,000 amount. We'll go through a little bit more detail in that in a further session. The other thing that is usually for a trading business in the asset section is an account called debtors, or if for other, depending on how you want to hold your mouth, that's also known as accounts receivable. Okay, so that's the money that your customers owe you at that particular date. So that will be the recording of the sales for which you haven't yet been paid. Then there'll be an account in the balance sheet called stock or inventory. Now this could be, let's say you're a car dealer. Your stock figure will include all the cars that you have on hand at that particular date. It will also include any and all spare parts that you're holding on that particular date. So when we look at the assets in there, it will be everything that you can actually pick up. There are some funny rules about stock, but we won't go into those at the moment. That's a bit more technical. But that will include what you can actually put your physical hands on as at balance date, as I said in the earlier session, 30th of June for Australian businesses. So we'll have cash at bank, debtors, stock and inventory. Now, when we look at the asset section, you'll usually see there are two components to the assets account. There will be what's called current assets and non-current assets. Okay, so with the current assets, when we talk about current assets, they're assets that we are going to use or sell or collect or deal with within the next 12 months. So our cash at bank we're going to use within the next 12 months. Our debtors, I'd certainly hope that we collect them within the next 12 months. Our stock and inventory, we would look at selling that and collecting the money from that in the next 12 months. So when you see something that's called a current asset or a current liability in the liability section, that means that that is going to be realised within the next 12 months. We go to the non-current section of the balance sheet for non-current assets, and they're assets that have a useful life or have a period of being used by the business for a period over 12 months. So that will include generally cars, because you won't generally trade your cars, your sales team's cars or your manager's cars or what have you, within a 12-month period. It will include your factory. It will include your shop. It will include the equipment that you use to manufacture the products that you make. So we can look at that and say, well, I'm buying this machine. Like, for instance, when we bought this whiteboard, this has even though we paid for it 10 years ago, we're still using it. So that this theoretically is a non-current asset because it has a useful life above and beyond the year in which we paid for it. And there'll be another session where we'll talk about depreciation and recognising the period over which we use these assets. So generally you'll find the major components of your current assets in the balance sheet will be, as we talked about before, cash, debtors or accounts receivable, and stock and inventory. That'll be the real core of what's in there. There can be some other accounts in there, but that's probably getting a little bit more detail than we want to get in these sessions. When we get to the non-current assets, I'll actually list them. Well, I'll do them separately because, well, there's quite a few of them that we need to look at and to aid in your understanding. So we've done the current assets. With the non-current assets, there will generally be a few things in there. There will be things called investments. Now, hopefully you've got investments, and they can be things like long-term cash deposits. They can be your factories, they can be land, they can be shares in other companies, or any sort of investment that you're going to hold for a longer term. There will also be what we call P&E, or plant and equipment. Now, as we talked about a minute ago, that will be the assets that you use in your business to create what you create in your business. There will, plant and equipment, there will be land and buildings. Okay, we all know what land and buildings are, and we generally buy them to use them over an extended period of time. I talked in the earlier session about tangible and intangible assets, and generally we recognise intangible assets as a non-current asset in the balance sheet. So an intangible asset, as I mentioned before, could be intellectual property. And intellectual property can include trademarks, it can include patents, it can include rights that you've sold to other people under licensing arrangements and those sort of things. So intellectual property is an intangible asset. We can't actually pick it up. It's more in the it's more a right and a capacity to operate within a certain framework that gives you the intellectual property. Other non-current assets that we can have, we talked about the intangible assets, can be a thing called goodwill. Okay, and goodwill, similar to intellectual property, you can't pick it up and handle it. Goodwill is the excess of what you pay for an asset over its actual worth, and you generally find this with a lot of businesses where even though their physical assets might be worth $100, someone's prepared to pay $150 for the business, and that $50 premium is an intangible, and that relates to the goodwill when they purchase the business. So I hope that gives you a bit of a better idea on what the non-current assets components and the current asset components you'll see in a balance sheet.